In this video, I'll be sharing 7 of the best dividend stocks you should have in your portfolio. These 7 stocks are the best of the best that have raised their dividends every year for the past 25 years. As a bonus, I will share a very important tip at the end, so make sure to watch the entire video. But first, what's a dividend stock? Dividend stocks distribute a portion of the company's earnings to investors on a regular basis. Dividend stocks can be a great source of income. But the best dividend stocks can also be an excellent way to increase your wealth over time. However, not all dividend stocks are great investments, and many investors aren't sure how to start their search. No worries, I've done the boring homework for you. Here are the 7 best dividend stocks to buy and hold. First on the list is Target. In the cutthroat world of discount retailing, Target has consistently proven it doesn't have to compete on price to win. For years, it has proven more profitable than its peers, with some of the highest gross margins and operating margins in retailing. At the same time, its focus on increasing its e-commerce business and expanding in-store offerings has kept sales and profits growing at a nice rate. With dividend growth at 50 years and counting, dividend investors should put Target on their shopping list. Next on the list is Hormel Foods. Hormel is an iconic food maker with brands like Spam and Planters among many others. The company's strong brand portfolio allows for consistent revenue as well as steady dividends that have fueled 56 consecutive annual increases to its payout. The firm has been buying up higher margin products while shifting out of commodity businesses and has a direct selling force in the food service space that gives it a competitive edge. It's also working to expand its reach globally. Hormel is a great stock to weather any economic downturn, as people who cut back on spending will eat at home more to save some cash. And with more than 40 brands that are either number 1 or number 2 in their category, that is sure to benefit the company's bottom line. Up next is Chevron. Chevron is an integrated oil giant that has operations in natural gas and geothermal energy. It also happens to be the lone energy sector name among the 30 stocks in the Dow Jones Industrial Average. Chevron has the strongest financial base, a highly attractive portfolio of assets, and the most attractive risk-reward profile of any stock in its peer group. If oil and gas prices stay high, Chevron will continue to have huge profits. But even if prices fall, Chevron has a wide margin of error where it can still do incredibly well. However, there's much more to like in the long run than just the tailwind from high oil prices. Specifically, Chevron has increased its dividend for 35 consecutive years, making Chevron an easy choice for any dividend investor's portfolio. Next on the list, we have Coca-Cola. Coca-Cola owns some of the biggest soft drink brands in the world, such as Sprite, Coke, Smart Water, Vitamin Water, and much more. The stable nature of its revenue in tough times make Coca-Cola a good safe haven stock. There are a bunch of reasons explaining the stock's stability, including 6 decades of dividend increases and more than 120 years of successful operations. And with Warren Buffett's investment company Berkshire Hathaway as Coke's largest shareholder, there's lots of reasons to have faith that this company has strong institutional interests that will keep shares stable in any market environment. Up next, we have Colgate-Palmolive. Colgate generates consistent recession-proof revenue from its wide array of consumer brands such as Colgate toothpaste, Speed Stick deodorant, and Palmolive soap. Colgate is a great investment for low-risk portfolios thanks to its stable operations in any environment. After all, people will continue to buy toothpaste and cleaning products regardless of whether the economy is up or down. The company's 6 decades-long commitment to dividend increases makes them an attractive stock for those looking to buy and hold for the future. Next on the list, we have Johnson & Johnson. It's hard to imagine a US company that is more entrenched and recession-proof than Johnson & Johnson. Johnson & Johnson is the perfect middle ground between a high-margin healthcare firm with branded devices and pharmaceuticals and an ultra-reliable consumer play. The company has developed branded drugs to treat a variety of conditions such as cancer and HIV, as well as owning massive over-the-counter products like Tylenol and Benadryl. Healthcare is an incredibly reliable sector, since those who are sick seek out care regardless of whether the market is up or down. The company is also one of just 2 firms on Wall Street with a AAA credit rating, and on top of that, Johnson & Johnson has a track record of more than 6 decades of dividend growth, making Johnson & Johnson a no-brainer dividend stock to add to your portfolio. Up next, we have Procter & Gamble. Procter & Gamble is one of the best-known dividend stocks on Wall Street. It is also one of the most consistent when it comes to increasing its payouts over time. In fact, Procter & Gamble has been paying a dividend for more than a century and has increased its dividend for 66 consecutive years. Procter & Gamble's wide product portfolio includes popular brands such as Gillette shaving products, Tide laundry detergent, and Charmin toilet paper. These are recession-proof expenses that don't get carved out of family budgets when times get tough or money gets a bit tight. So if you're looking for a reliable dividend stock, put Procter & Gamble on your shopping list. I promised you a tip at the end, so listen up. This next part is very important. Dividends and taxable brokerage accounts cause taxes to be realized in the year the dividends occur. Also, for individuals with taxable accounts and in high income brackets, dividend stocks might not be as tax efficient as other options. Therefore, it is highly encouraged to use a tax advantage account such as a 401k or an IRA when dividend investing to avoid any unnecessary tax situations. If you want to learn more about 401ks and IRAs, click on the card on the top right corner to watch my video on how to start investing, where I discuss, among many things, the pros and cons of 401ks, IRAs, and taxable brokerage accounts. If you enjoyed the video, make sure to smash the like button
for the YouTube algorithm
and subscribe for more content. Thanks for watching.